You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Frank Gallinelli. Now, Frank is the author of the best-selling book, What Every Real Estate Investor Needs to Know About Cash Flow, now in its third edition, as well as other books and numerous articles on real estate investing and finance. A graduate of Yale University, he has served as adjunct assistant professor of the real estate development at Columbia University. Now, Frank has been involved in real estate for more than 40 years and is the founder and president of Real Data, a real estate software firm that has offered analysis and presentation tools for investors and developers since 1982. Now, Real Data provides educational resources for investors and for use in academic environments. Now, and for those that aren't aware, we actually had Frank on the show way back on episode number 9, I believe it was, which was 250 episodes ago here of the Real Estate Investing for Cashflow podcast. So it's been about 5 years. And just like us over here at Sunrise Capital, Frank is still going really hard at the real estate game. And I thought it would be very fitting to bring him back on and find out what he's been up to for the last 5 years, because at the end of the day, a lot of things happen in 5 days, let alone 5 years. So I'm excited to have him back on and to find out just what's really going on and also discuss some very fun topics today. And some of those topics that we'll be discussing and covering in today's show are the following. What metrics commercial income property investors should really focus on most, especially as they're learning the business and just getting started. Also, what are some of the biggest mistakes new commercial investors make when getting started? What are the best ways to analyze a commercial real estate deal and make calculated predictions on its future revenues? And then also, what commercial real estate solutions Real Data, Frank's company, provide to commercial investors like you and I. Additionally, one of the big bonuses of the show today is Frank's going to share details on how you can receive a 30% discount code for his commercial real estate investment analysis course. But you'll need to wait until the very end of the show to get that promo code, okay? So you got to tune in. Now, guys, if this is the first time that you're joining us here on the show, I want to just welcome you to our family that we have here at the Real Estate Investing for Cashflow podcast. So if you're one of the many millions now of listeners who make listening to the show a part of their weekly ritual, I just want to welcome you back and just thank each and every one of you from the bottom of my heart for being a part of our family. We wouldn't be here if it wasn't for you, so thank you. And for this episode, I'd like to do something that we haven't done for quite some time. In fact, I think it's been a number of years and it's way overdue. And let's give a shout out to one of our very awesome listeners who took the time to leave a 5-star rating and review over on iTunes. And this review is from Brandon. Brandon says, each episode will always have informative content no matter what your niche may be or what investments you're into. I've never listened and not learned something new. Keep it going, Kevin. So thank you, Brandon. Really appreciate that. Again, guys, if you really enjoy what we're doing here, please take a minute, subscribe to the show. And if you're so inclined, please leave us a 5-star rating and review. And I'll be sure to give you a shout out on an up and coming episode. Really, these reviews are a way for us to attract awesome new guests like Frank. They want to come back on the show because they see that we're making some traction and we're making a huge positive impact on people's lives. So it's also a way for us over here to obtain feedback directly from you as to what you'd like to hear more of on a weekly basis, or maybe not hear of on a weekly basis. So please take some time to go over there and do that for us. And just 2 real quick housekeeping items before we get onto the show with Frank. First and foremost, I want to remind you about the free 30-minute phone consultation with me that I just started offering again after a 1-year hiatus, where you can simply ask me anything you like about real estate or get my feedback maybe on a deal that you're working on, okay? Basically, anything that you want to discuss related to real estate investing for 30 minutes, I'll essentially be your personal sounding board. And it doesn't matter if you're brand new or you haven't done a deal yet, or on the flip side of that, if you're a seasoned investor and you just want to talk shop. I'd love to get to know you better and lend a hand where I can offer advice where you might need it, okay? I've literally had the opportunity to speak with hundreds of you over these last couple of years and look forward to taking advantage of it once again and meeting each and every one of you. Just one disclosure. We will be conducting this call via a video chat on Zoom, and we'll be recording it. So I just want to let you know that ahead of time. If you'd like to schedule that 30-minute phone call with me, what you need to do is go to my website, kevinbupp.com, and scroll about 3/4 of the way down on the homepage. On the right-hand side, you'll see a button that says schedule a call with Kevin. Just go ahead and grab a time there off my calendar, and be sure to include a little background on yourself as well as what you'd like to talk about on our call. If you've got specific questions, if you've got a topic that you'd like to chat about, make sure that you put that information there. This will better help me prepare and ensure that this 30 minutes is spent as efficiently as possible together, okay? And just so you know, I'm going to put this out there just as a disclosure. This isn't a call where I'm going to try to pitch you or sell you on some type of program or coaching. It's just simply a way for me to give back and connect with each and every one of you, okay? I just wanted you to know that. Another important announcement before we get on to the show with Frank is we are hiring here at Sunrise Capital Investors. We're looking for some rock star talent to join our team. We're growing at a very rapid rate. And so if you have an interest in joining us here in sunny Florida, joining our very dynamic team that we've been growing here, we'd love to hear from you. You can go visit our website and see about our open positions. It's careers.sunrisecapitalinvestors.com. Again, careers.sunrisecapitalinvestors.com. And now, guys, on to the man of the hour. So without further ado, I'd like to welcome our guest for today's show, Frank Gallinelli. Frank, how you doing, my friend?
Good. Thanks. Thanks for having me back on. It took 5 years for you to recover from my last podcast. Sorry about that. Jeez.
No, I think it took 5 years to absorb all the incredible information that you actually shared in that 1 hour podcast. I think that's what it is. So we'll really appreciate you coming back here, Frank. And being that it's been 5 years, we have probably a lot of listeners that have not been listening for 5 years, and maybe they haven't taken the time to go back and listen to hundreds of hours of my previous shows. And even though they should have, but in any event, if they're not familiar, with you and your background, maybe you could just take a few minutes and tell us a little bit more about yourself. And in addition to that, I know one of the big things about you, Frank, since I've known you now over 5 years, your book was one of the very first books I picked up on the topic of commercial real estate investing. You put a huge emphasis on investor education. So I'd love also, in addition to your background, maybe tell us a little bit how your interest in education evolved, and what are some of the best ways and maybe even some of the worst ways that you think investors can, better learn this business?
Sure. Thanks, Kevin. Yeah, everything is connected to everything else. So our software business and our educational mantras and whatnot all kind of dovetail together. The story goes back about, as you said, about 40 some odd years when I got into the software business. And it was not my intention to get into the software business, quite frankly. I was in real estate, was buying a particular piece of commercial property for myself, and kind of coincidentally at the same time had acquired one of these funny little boxes that no one had ever seen before called a personal computer. Now, we're talking about 1980 right now, okay? So if I had invited all the people who had personal computers to my house for dinner, I probably would have had some empty seats around the table. But I figured, well, this looks interesting, so maybe I can figure out how this deal is going to play out. So I tinkered with that, and I tinkered with something that I'd never heard of also, at least not electronically, called a spreadsheet, and put together an analysis. And the deal, we did make the deal. We had some partners involved. But the interesting thing that came out of all of it was that one of those partners looked at what I had done, and this was a fellow who, quite frankly, I think was a good deal smarter than I was. And he just looked at it and he said, "How'd you do that?" So that's how we went into the software business, before there was a software business, I think. And we've been doing that now. I should probably be able to do the math in my head for the exact number of years. But we called it Real Data. Now, of course, it's realdata.com for the last 20 years or so. But we've been in business doing this for about 37, 38 years. And when you talked about education, these things do kind of dovetail together. The software business, of course, was intended to help real estate investors do the same kind of financial analysis that I was doing on that piece of income property that I was looking at. But, we're in business for a while, and a couple of years go by. It was maybe 6, 7 years. We're a small company. We were a small company then, to just a couple of folks, and we're sitting around talking about the various support questions that had been coming in, when we realized that a good number of the so-called tech support questions weren't technical at all. They were people who were asking us about how to analyze the property. And what we realized in that conversation we were having was that although a great number of people who were using our software knew how a real estate deal worked, there was a percentage of those people who, by the questions they asked, kind of made it clear that they didn't really get it. They didn't understand how a real estate investment worked. So we said, I think maybe we ought to put some of our focus on investor education. And I will confess, this was an entirely self-serving decision on our part, because we made that decision because we figured, well, if people understood better how to analyze a property and how to calculate the metrics and what the metrics made and what the metrics meant once you put them in front of yourself, we would probably sell more software, because people would recognize the fact that the calculations we were doing, the presentations we were making, were useful and helpful to making investment decisions. So, a well-educated customer was going to be a good customer for us. But as time went on, I kind of got more and more involved in the educational aspect of the business. I still have the same couple of guys who were, I think, sitting around in that conversation, and they do all the hard work. I just take all the credit. But the educational aspect of it became more and more interesting to me. And that led to one day the phone ringing, and it was an editor from McGraw-Hill asking me if I wanted to write a book, the very book that you were mentioning, Kevin, that is now in its third edition. And I didn't realize how I should react to an editor calling from the gazillionth floor on 6th Avenue in New York, asking me if how would I feel about writing a book. So I gave the guy a hard time. But I wrote the book anyway, and the rest, as they say, is history. It's become certainly more popular than I ever imagined, more popular actually than they had ever imagined. And I think that probably is because I was simply trying to, like the fellow in Dragnet, just the facts, man. I'm just trying to tell you how it works, and not trying to load a lot of hype on you. And that's when we get into any conversation about, how do you learn this business? How do you get an education? That, I think, is what I've tried to do to differentiate our educational offerings, anyway, from a lot of the stuff I see online. A lot of that material I see online, it seems to me to come from a variety of, not so reliable sources. Sometimes these are kind of the self-anointed experts and gurus who are they're experts on real estate because they lived in a house once.
That's it.
They may want your love and respect, but they probably also want your money. And I wouldn't always call their advice spot on. It's kind of heavy on the motivational stuff. And I made a concerted effort to avoid all of that stuff in my writing and my courses, and because I believe it's delivering real information was going to be more useful.
Well, I can tell you that, being someone that's read your book, it's probably one of the books that I most recommend here on the show, and I have over the years, is you take what can be really misconstrued as incredibly complex information, and some of it really is, and you break it down into layman terms. But not only that, you don't just break it down into layman terms, you actually make it readable, and it's not, it doesn't make you fall asleep. I mean, and it really is, it's one of those topics that, or the multitude of topics that exist inside that book. I wouldn't say that it makes you, want to get up and jump all over the place and excited and do jumping jacks. I mean, but you make it to where it's very captivating, and it's something that can be immediately put into use. And so in any event, I highly recommend the book to everyone that's listening. I mean, if you haven't, read the book, go grab a copy. I mean, what is it now? $15 on Amazon. I mean, it's a very, very affordable, very in-depth education. If you're really serious about getting started in your commercial real estate investing career, then that really is it should be your foundation. I mean, it's where you should work from. So with that, what I love to do, Frank, and it would probably take many, many hours to actually discuss all the 37 different metrics that you cover in that book. And so what I'd really love to do is to make the most out of this time that we have together. We've got about 35 minutes left here. And so what I'd love from you is, maybe from your perspective, what do you feel are the most important metrics? Maybe if you could pick like the top 5, or however many you feel that are the most important that folks should focus on when getting started. What are they?
Well, as you said, the title was Cashflow and 36 other, whatever the title was. McGraw-Hill wrote the title. I could never remember what it was, but I think I had that many metrics in there because I had a page goal that I was supposed to set for the first edition. But you're right. I think you can focus in on a handful of metrics that are really essential. And to kind of give a background to how I might pick out that handful. When I teach my grad students at Columbia, I always tell them to think of an analysis in a linear way, kind of in a stepwise fashion where one thing more or less logically follows from another and so on. And I tell them to do that because it'll be beneficial in at least two ways. Number one, it helps you to organize your own thinking about how you're analyzing this investment. But perhaps almost as important, it also helps you to make a presentation to a third party after you've analyzed a property, a presentation that they can actually follow. So it doesn't turn into a scavenger hunt of information.
Mm-hmm.
So I think being linear really means understanding that a couple of metrics follow logically kind of one after another. So having said that, what might those metrics be? Well, I think I would always start with NOI, the net operating income,
mm-hmm.
because a logical place to begin the analysis of a property is to look at its current and perhaps projected revenue and operating expenses. What we used to, back when investors first learned to walk upright and I got in the business, we used to call it the APOD form, and I still call it that both in my software and books and course and whatnot, annual property operating data, which is kind of the real estate equivalent of a profit and loss statement.
Mm-hmm.
So you start off with the revenue and you decrease that by the operating expenses and you get to a line called net operating income. And that's a very useful line, but it has to be done correctly.
Mm-hmm.
And here's a place where sometimes beginning investors, they didn't get the memo on how that's supposed to be calculated correctly. An operating expense is something that you have to pay out in order to operate the property. So I can remember back in the in the early days of doing our software, someone would call us up and say, "Oh, your software is broken," and I say, "Well, what's the matter with it?" They say, "Well, it didn't give me a line to put in my mortgage interest as an operating expense." I says, "Yeah, well, that's okay because it's not an operating expense. You don't need a mortgage to operate a property. You might need it to buy a property, but you don't need it to operate.
Sure.
You don't need depreciation to operate a property."
Mm-hmm.
So you have to put these things in. You have to follow the logic that's followed by everybody else in the industry. Otherwise, you're talking gibberish to other people. An appraiser won't know what you're talking about, or a lender won't know what you're talking about if you don't use the standard definitions. So you get down to that net operating income, and that gives you some useful information because it then connects to a couple of other metrics. The first of these is cap rate, capitalization rate. And capitalization rate is what your typical valuation would use. If you were using a commercial appraiser, that appraiser would apply the cap rate to the NOI in order to give an estimate of the current market value. So you need to know that there is a relationship between the NOI and value, at least at a particular point in time when you're looking at it.
Mm-hmm. I want to, before we move on, Frank, if we could, I feel like cap rate, and I'd love to get your feedback on this. I feel like it's one of those, it's probably the most common metric used when valuing a property. And I think sometimes it's misused. And, more importantly, in today's world, I feel like the word value add gets thrown around like it's a commonality, right? Like everything's a value add property. And I tell you that, we are value add investors. So I'm going to throw it around here today in the show. We are value add investors. Most things we buy, they have a great deal of upside there and, some sort of distress or another. Mm-hmm. And so to us, cap rate really isn't relevant. It's just not on the buy side. It surely is relevant on the sell side, and really in our projections as well as we model this thing out over the next 1, 3, 5 or whatever our hold period is going to be. The cap rate is relevant then on the back side, but it's not as relevant on the front side. What's more relevant to us is the cash on cash metric and when we can actually achieve whatever our initial target might be, whether it's the first 12, 18, 24 months. And so I get a lot of folks that come to me and they say, Kevin, I know you're buying properties. What cap rate are you paying? And I don't know anything else about I don't know where the property is located. I don't know the size. I don't know any details about it. I'm like, well, I don't know how to answer this eloquently enough, but cap rate's not really relevant to me. I'd like to learn more about your property before, we could really discuss cap rates. And I just think it's not really part of the conversation now. And so I would love to hear from your perspective, how you feel about that. Do you think I'm wrong in my approach regarding how I use cap rate and sometimes where I don't even factor it into the equation?
Well, I think cap rate tends to be overused. It has a purpose,
mm-hmm.
but I don't think it has quite as essential a purpose as some investors make it out to be.
Yeah.
A cap rate will give you a kind of a snapshot look at what the valuation might be. It'll give you an idea, especially if you're interested in getting financing, as to what this might get appraised out for, because that commercial appraiser, it almost certainly is going to be using the cap rate and the NOI as a part of that appraisal process. So if you don't know, what the market cap rate is, and cap rate, I get this question quite a lot. What's a good cap rate? Well, there is no such thing as a good cap rate. A good cap rate is just an invention.
Yeah.
Market cap rate is very much, it's like politics. It's extremely local. It's not only local, but it also pertains to the specific property type. So an appropriate cap rate for a property to apply against its NOI would be confined to the specific market that property is in and the specific type of property, retail versus office, whatever other type of property you might be looking at. You'd have to look at a cap rate that was specific for that. And then the information it gives you might have some value because it will give you an idea as to how the thing might appraise out. Mm-hmm. It also can give you an idea if a property that you're looking at or a market that you're looking at might be overheated, because you can get some historical information about cap rates for a property type in a particular market. And let's say that historical information tells you that cap rates for this type of property, right, in the central business district have been 7%, more or less, over the past several years. And now you're suddenly finding that the cap rates of properties that you're looking at are 4 and 5%. Well, maybe this makes some bells go off in your head and say, this could be an overheated market. So it does have a place. It has a use, but I don't think it has a use that some investors put to it, and that is say, I'm going to simply, apply the cap rate against the NOI, and that's how much I ought to pay for this property. That's a bad decision, okay? Because that only tells you what the property is worth in terms of current market value. It really doesn't tell you anything about how it's going to perform for you over your investment horizon.
Mm-hmm. Yeah, absolutely. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cashflow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASHFLOW without the O. Again, that's 833-CASHFLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. Okay. Well, I appreciate that. And I don't mean to derail you by any means. I thought that was an important topic that we need to dive a little bit deeper into. So
I'm easy to derail. Feel free to go ahead and do it all the time.
So what's next? Give me one of the other, I guess, the metrics that follow directly in line with cap rate.
Okay. Next one's not even a metric, but just as a side note, the next thing kind of in your linear process is you need to understand how to calculate debt service, because debt service then is going to lead to our next important metric, which is debt coverage ratio. And this is one that gets ignored an awful lot. Mm-hmm. So we've gotten down to the NOI, probably 3/4 of the way through our podcast time here, and I'm only on the second one. But we've gotten down to NOI, and debt coverage ratio is where you look at how much wiggle room do you have in that net operating income to pay your mortgage. And it's important for at least two reasons. One is underwriting. If you haven't got a debt coverage ratio that satisfies your lender's underwriting requirements, you're not getting the loan. Okay. Now, before the economic meltdown of 2008, typical debt coverage ratio requirement from a lender would be somewhere around 1.20. And what that would mean is that you ought to have 20% more net operating income than you really need to be able to pay your mortgage. Mm-hmm. And that's because, as I say in one of my books, I said, you're much more likely to encounter unexpected expenses than you are to encounter unexpected revenue.
Very true.
So you need to have that. You need to have that slush fund. You need to have that wiggle room. Since 2008, I've seen typically 1.25 is the most common, and it can even be higher. So debt coverage ratio derives directly from that NOI metric. And while now we're on the subject of financing, another metric that investors need to have in their quiver, another arrow there, is loan to value ratio. Mm-hmm. Because if you're going to be going out looking for financing of this property, you need to know that your property satisfies the debt coverage ratio requirement of your lender, and it's also consistent with their loan to value requirements. So if a lender says that we won't loan more than 65% loan on a loan to value basis, then you need to know that before you walk in looking for a loan. Mm-hmm. Because if you haven't structured the deal so that you have a realistic debt coverage ratio and a realistic loan to value when you're going for financing, you're going to make yourself look foolish. Mm-hmm. Okay, moving on down the line. You've gotten down, you've inched your way now past the NOI, mm-hmm. and you've considered the debt service. The debt service is the next thing that comes out of your pocket. And once you've got that debt service paid, the line you're on is cash flow. And this is probably the most important thing from a practical point of view that most investors will look at. Mm-hmm. Because you want your property to support you. You don't want you to support your property. And that means that you need to be able to realistically anticipate that you're going to have a positive cash flow. So you need to be able to follow this thing down the path there to look at the cash flow. And so far, we're only looking at things in the first year of operating the property. And that's why we need to now move to the next series, if you will, of metrics to kind of, tie a bow on this. And that is to think about the fact that you're probably not going to own a property for just a point in time. You're probably going to hold it because that's what investing more or less is all about. So you're going to be holding a property over time, which means you're going to have not just a cash flow in a first year, but you're going to have another cash flow when you've owned the property into the second year. and a third cash flow in the third year, and so on and so forth. And then ultimately, you're going to come to the year when it's time to sell the property, and you're going to have yet one extra cash flow, the cash that comes from liquidating your investment, from selling the property. So now you've got what is really the essence of a real estate investment, which is an income stream. You've got a series of cash flows. I've probably worn this explanation out in explaining it in trying to explain it to people, but you're not buying a pile of lumber or bricks or BX cables or all this other stuff when you buy a property. You're buying an income stream.
Yeah.
And that's the whole essence of what a real estate investment, a commercial real estate investment, is all about. You're buying an income stream. And when you buy that income stream, you have to be attentive to the fact that not all the income ends up in your bank account on the same day. If this is a 5-year or a 7-year or a 10-year holding period, you're looking at an income stream that's going to wax and wane over time, especially if it's truly commercial property, commercial in the sense of non-residential, where you're going to have, in many cases, long-term leases that have built-in bumps, where the income may be already scheduled to increase over several years, and then you come to an option period, or you come to a point in the cash flow stream where maybe that tenant's going to leave, and you're going to have to deal with a rollover vacancy and these other things. So you can make projections that will go out over a period of time. And when you do, you've got to be attentive to the fact that money received in the future is less valuable than money you get today. The classic time value of money story. Mm-hmm. So you've got to look at those future cash flows and say, okay, if I have to wait for that second cash flow until next year, well, I've got to discount the value of that cash flow. I don't take it into account as being its face amount, but I take it into account as being its next year amount discounted by some percentage. And the third year, discounted by some percentage, but discounted over a longer period of time. So it shrinks even more. And the fifth year and the seventh year, discounted back over more and more periods. So the longer you go out, if those cash flows were just by, for the sake of argument, were all identical, each one would have a lower value to you today than the one that you received earlier.
And I surely don't want to derail, but I think the discounted cash flow analysis is an important topic. And I don't want to go get too in the weeds here, but is there a general rule of thumb to determining the devaluation of that cash flow, that future cash flow, year 2 to 3 to 4 to 5? Is there a general rule of thumb that one can use, or no?
I don't think so, but that's why I like the you're getting to my bottom line here on this entire linear progression of
well, I'm going to let you roll then.
Yeah, because
please do.
Because when you do that discounting, it does presume that you know what is the appropriate discount rate. Mm-hmm. So you're finding the present value of all these future cash flows. And just as an aside, I'll derail myself now if you'll allow me to.
Sure.
There's present value and there's net present value. Mm-hmm. I can tell you from having taught this to grad students for 15 years that almost nobody on this planet knows what the difference is really. So I'm going to tell you, present value is when you find the current worth of some future cash flow. So let's say you have a series of cash flows and you find the present value of each of them and you add them up. That's the present value of the entire income stream. Mm-hmm. The net present value is where you subtract out what you paid to get those future cash flows. So net present value subtracts out the cost of all the cash flows. Mm-hmm. On the assumption that you're actually going to pay something out of your pocket in cash to close this deal, that should be subtracted out from the present worth of all the future cash flows to give you a net present value. So now we've gotten ourselves not too deeply into the weeds, but we're doing what we call the discounted cash flow analysis. We're taking all the future estimated cash flows from this property, including the cash flow that comes from selling the property, and we're finding out, or estimating, I should say, finding out would definitely be not a good term to use here. We're estimating what their present worth would be, present worth of each of them. And when we bunch them all together, all those present worths together, we've got the present value of the entire income stream. Mm-hmm. And the present value of the income stream, since I said the income stream is what you're really buying, the present value of the income stream is the present value of your investment.
Mm-hmm.
Okay, good. But your question was right on the button, Kevin, because the choice of a discount rate can really make or break your analysis. If you get a discount rate that's a little bit off the wall, you can prove anything with statistics, right? And you can probably prove any valuation for the property by picking a discount rate that's maybe not the one you should have. So the flip side of the discounted cash flow using present value and net present value is internal rate of return.
Mm-hmm.
And from our whole bunch of years of dealing with investors through our software and having them call us and asking questions and telling us about their deals and so on, I think I'm reasonably safe in saying that the IRR is the metric of choice
mm-hmm.
in terms of decision making of most of the experienced investors that we deal with. Now, that doesn't mean they all understand what IRR is, but they do understand that the higher it is, chances are the better it is.
The better.
Okay? Except for those silly few people who, when they see an internal rate of return of 72.5%, don't realize that what that really means is doesn't mean that this is a great investment. What it really means is you did the math wrong.
Yeah.
Okay. But the internal rate of return is simply doing the present value calculation, but where you're going to change what the unknown is.
Mm-hmm.
Okay. Stay with me on this for a second, because this may make a few light bulbs go off on people who've always wondered, really, truly, what is internal rate of return? Okay. If you were doing that present value calculation, what you're saying is, I think I can estimate, okay, what the future cash flows are going to be. And I think I can estimate what discount rate I ought to apply to those cash flows. And when I do, I can discount those future cash flows, and that will be the present value of the future cash flows. Okay. Everybody with me now?
Mm-hmm.
Okay. Instead, what internal rate of return says, okay, we're going to take that same situation. I still think I can estimate the future cash flows. But now, the other item that I think I know is what they're worth today. How can that be? Well, let's say you're in the middle of making a deal and you've got to put $100,000 in cash to buy this property, the financing over and above that and so on. But let's say you've got to put $100,000 in cash. Well, what you're really saying is that's what the future cash flows are worth if I buy it on these terms. So the future cash flows are worth $100,000 because that's what I'm putting into the deal on day one or day zero. What discount rate would make all those cash flows worth what I'm paying for them? That's what internal rate of return is.
Mm-hmm.
It manages to find what discount rate would actually describe getting the cash flow that you're expecting in year one, the cash flow you're expecting for year two, in year two, and so on and so forth. One discount rate that would make all that come out true and equal the amount that you're paying for those cash flows. That's the internal rate of return. And that gives you, I think, the probably, although all measures of investment quality are imperfect, this one gives you, I think, the one metric that can account for both the magnitude and the timing of the future cash flows to give you a picture of how your investment dollar is going to perform based on your assumptions as to what those future cash flows are going to be.
Mm-hmm.
Have I worn everybody out now?
No, I think it's great information. And I think that it's even more relevant today than ever. And what I mean by that is, with the advent of crowdfunding and sites like Real Crowd and, all the other ones that are out there, and there's probably hundreds of them now, but, to where the average Joe now has access to many different grades of investment quality real estate, and everything's marketing, right? And that's where really, at least it starts. And a lot of folks are drawn to that IRR number, right? Projected IRR number of any individual investment. But I think where the challenge comes into play is them not actually understanding how that, I guess the sponsor arrived at that projection. and how to actually poke holes in it and make a determination as to, is it even realistic that investment can ultimately achieve that over the whatever the time horizon might be. And so I think that's where the challenge comes in, Frank. So I'd love your perspective as to what advice you might give to folks that are out there that are just getting started, that maybe don't have an advanced level of education like yourself or some of your students, or maybe even someone that's read your book, right? What advice would you give those folks just to make sure that they're getting themselves into an investment that makes sense, that isn't just a big marketing gimmick with a number pulled out of the sky as far as projected IRR?
Well, I think the first bit of advice would be, when you're looking at a third party of proposition in terms of is to do your due diligence. You've got to do your due diligence. And that is one of the mistakes that I see beginning investors make all too often.
Mm-hmm.
They don't really do their due diligence as thoroughly as they ought to, which means you've got to not only look at a piece of property as a physical asset, because that matters, obviously. If it's falling down, this is something you want to know. But you have to do a financial due diligence as well. So if someone's giving you a set of numbers, it's reasonable to ask, where did they come from? Where did those numbers come from? Okay, where did those projections come from?
Mm-hmm.
May I see the leases on this particular piece of property? So your due diligence has to include all of that stuff, but it also has to include, I think, something that you can do independent of the property itself, and that's the market due diligence, because properties don't live in a vacuum. So you need to absolutely look at the ecosystem around a piece of property to understand the financial dynamics, if you will, of the market that this property lives in. So you'll have some idea, given the employment situation and given the political situation in a particular market, do I think that these projections make sense? Now, of course, you're looking at, from what you're describing, the projections that are handed to you by a third party, but certainly, in many cases, and certainly the cases that we see through our software company, because people are looking at properties that they in themselves might be the packaging for attracting investors and whatnot.
Mm-hmm.
But looking at properties independently, I think one of the things that I always tell people that you really need to do is to do not just one discounted cash flow projection. You absolutely must do a discounted cash flow projection. And even that suggestion, by the way, I get some blowback on, quite frankly, because people will say to me, oh, you're telling me that I need to try to predict what the future operating expenses are going to be. And that's predicting the future. So I says, well, you know what? If you don't do that, you're still making a prediction.
Yeah.
You're predicting that the future is going to be just like the present because you're only looking at the present. That doesn't work either. What I tell people that they really need to do to make it a sensible discounted cash flow is to do at least 3 different versions of it. Best case, worst case, and somewhere in between. Because things never turn out quite as well as you hope or as bad as you fear. So the truth usually lies somewhere between those outside parameters. Then you start to ask yourself, well, can I at least live with this investment as long as I'm within those parameters?
Mm-hmm.
And then maybe start to see if you can narrow down those parameters to get yourself a best case or a most likely case scenario in between. But, the thing about investing is that it does require a willingness to accept uncertainty.
Mm-hmm.
Because you don't know with any investment, and it doesn't just have to be real estate, you don't know for certain what the performance is going to be in the future. You can have a pretty good idea very often, but you don't have absolute certainty. And if you're expecting absolute certainty, you're going to get disappointed.
I think that's what we define as risk, right?
It's exactly what we define as risk. And if you really, if every Tom, Dick, and Warren Buffett, were out there and had perfect knowledge of what's going to happen in the future, then we would all be billionaires. But we're not, because making successful investments involves a willingness to undertake risk and a willingness to make smart evaluations as to the level of risk that you're going to be encountering, to make smart forecasts of how a property might perform. I've got an example in my bigger course, not the one that we're going to talk about in a little bit. In my bigger course, It's kind of a variation of one that I've used in my grad school course, and it's one where one of the commercial tenants has a lease, and you can run the numbers on this mixed use property, using all the commercial tenants that I've got there, and one of them happens to be a restaurant. And as the story evolves in this case study, spoiler alert, by the way, I'm telling you about one of the cases. The prospective buyer decides to go and have dinner at the restaurant and discovers that they got the worst imaginable food and the most disagreeable waitstaff that he's ever encountered. And he says, you know what? I don't care what the lease says. These people aren't going to make it. Okay? So I need to redo my projection as to how this property is going to perform based on this real world evaluation. Okay, it's not just the numbers always. I mean, I'm a numbers guy, right?
Yeah.
But sometimes I say you got to look behind the numbers. I tell my grad students at the beginning, they really look at it. They are convinced I am certifiably nuts when I tell them at the very beginning of one of my courses that this is the closest thing you're going to get to a class in poetry anywhere in your finance curriculum, because it's just like reading a Shakespearean sonnet. You've got to look at not just the words, but what might be the meaning behind the words.
Yeah.
Okay? So that's part of your due diligence, to look for the story behind the story, because sometimes that's going to change how the story is going to end.
Yeah, I mean, in that example you just gave there, it's really, you're speaking to the quality of the tenants themselves, and it's relevant in a restaurant, it's relevant in retail. A grade A tenant in retail, a CVS versus the local Joe Schmo pharmacy, right? And the same goes with residential real estate. Could be mobile home parks or apartments, right? If the current owner does not have a screening process and he's turning over 70% of those residents every 12 months, well, a higher grade resident that actually has a credit score and a checking account is probably going to be a little bit more stable than the ones that he's currently putting in there. And so, no, that's a great example. Thank you for sharing that.
So yeah, go ahead.
No, I was going to ask you. I want to make sure that we get this in here, because we're running out of time, and I want to learn. You shared a lot of great information, and I want to make sure that we all fully understand exactly what your company, Real Data, what kind of solutions do you guys provide? I mean, we're talking about the analysis side of commercial real estate. You're very, very knowledgeable. I definitely recommend everyone go out and grab the book. But talk to me a little bit about the software itself and some of the other solutions that your company provides investors.
Yeah, the software as it has evolved over these 38 years since I was trying to build some spreadsheets.
Back when it was on a floppy disk, right?
Did we have floppy disk? The floppy disk back then was actually, it looked like a small pizza. It was 8 inches. And there's no such thing as a hard drive back then. So even the operating system had to be loaded first from one of these great big discs. So yeah, I go back to the dawn of man.
We're losing all the millennials that are listening in right now.
Right, you'll probably find me in that opening scene from 2001: Space Odyssey. Anyway, so what has been our flagship product over these almost 40 years has been what that initial income property analysis evolved into, which is essentially an APOD cash flow analysis that will also do a whole bunch of other things, such as partnership pro formas and that kind of thing. But it has become more and more sophisticated. It is still now based in Excel, but it's not an Excel spreadsheet in the traditional sense, because we've got thousands upon thousands upon thousands of lines of VBA code in the background that the user never sees.
Mm-hmm.
That makes a lot of the stuff happen. So it's not the kind of thing that you could say, okay, I can look at the reports and I could probably make that happen, because even I can't at this point. I've got some guys who are a lot smarter, who really know how to make this stuff work. So that if you want to print reports and that kind of thing, we got special menus for that. We have code in the background that runs a decision maker model that lets you kind of toggle among different assumptions to see how they affect the overall output of the thing. So that's basically our flagship product. We have a somewhat simpler version of it also for people who are not quite ready to dive into the deep end of the pool. And then we've got software for development. People who are doing commercial development to do project cost analysis or month by month cash flow and planning for a development project, the kind of thing that might be built and leased in stages. And then, of course, just a couple of years ago, we went beyond the just the software, and I developed what I feel is a fairly comprehensive online video course. Mm-hmm. I think now we're up to something like 54 videos that are in that course, plus resources and quizzes and other good stuff that are in there. So I try to take my, somewhat singular approach to looking at these things and to put it in there to make it accessible, especially to people who, like the visual as well as the written,
sure.
Visual information as well as the written word. And that has proven to be, joyfully quite a success.
And we talked originally in the beginning, I kind of give a little teaser of this mini course that you have. So you have I guess a smaller redacted version of the larger, 54 video course that you just spoke about. And we're going to give the 30% promo code. And so the folks that hung on, that listened to the end, I'm going to leave it up to you to plug it in there to give it to them.
Okay. Actually, what I did with this mini course, we found that a lot of people particularly found value in case studies. And so we've got a series of case studies. We had 3 different property types, and just a couple of weeks ago, we added a 4th, and that was one of the modules inside of the big course. So what we did was we spun that module out. I think it's about 10, 12 videos. I'd have to actually go in there and look to remember, but it's 4 different cases. And we spun that out into this mini course, so you can take that mini course and go through our case studies, a case study of a mixed use, of a triple net property, a triple net lease property, and so on. And so we sell that obviously for substantially less than the full course. But the nice thing is that anyone who starts off with that little mini course can simply upgrade for the difference in price to the full thing after you take a look at it and see. And so, just for listeners of this podcast,
yes,
if you go to realdata.com, I'm going to tell my guys, do not remove this from the homepage, because there might be people coming to visit this that I sent here. Right on the homepage, you will see that there is a little blurb about the case study course. So if you click on that and you go to buy it, instead of paying the $77 price that it would normally be at, if you say Kevin 19, you'll get 30% off.
All righty.
With my compliments.
Kevin is a special word.
It is.
It saves you money. Fantastic. Well, I really appreciate the generosity, Frank, in offering that to the listeners. And I had one more question about your financial tools that you offer. Do you have asset-specific financial analysis tools, or is it more general commercial based?
No, within the larger version of the real estate investment analysis software, we do have the ability to zero in on specific property type if you want to narrow down your focus. So if you want to have your reports and so on kind of focus on a particular property type, you can do that. We don't need to have separate programs for that.
Okay, got it. And do you offer any custom solutions for those that maybe find a need or a want? For example, we're in the mobile home park space, which is kind of its own animal, and we've created our own model over the years. But do you offer custom solutions for folks that might not be able to find a stock format that works best for them?
You can always talk to our, to the guys at our office to see if it gets them in the right frame of mind. But as a rule, we don't, because we spend an awful lot of time and attention making sure that we get the most content, the most value that we possibly can into our products, and we do that by listening to our customers and finding out just what it is that they need. So we're hoping that we cover the bases reasonably well with the products we have, but we always have an open mind.
Okay, fantastic. Well, Frank, I really appreciate you coming on the show and joining us back again after a 5-year hiatus. And you shared a lot of great information here today. And now I'd like to roll into what I call the golden nugget segment of the show. And this is where we're going to kind of wrap things up here for the day. And if you had just one last golden nugget of advice or wisdom that you could share with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
Okay. Whenever you start off analyzing a property, have the word clarity in the back of your mind. There's 2 kinds of clarity I think that you need to have always when you're doing any kind of real estate investing or real estate investment analysis. One kind of clarity is clarity in your own mind as to what is it that you really want to try to accomplish. What is your purpose in buying any particular property? Are you looking for cash flow? Are you looking for long-term capital appreciation? But understand what it is that you're trying to do. Because as Yogi Berra once said, if you don't know where you're going, you're going to end up someplace else. The other kind of clarity is an outbound clarity. Because if you can't evaluate a property and also explain it to a third party, explain your point of view to a third party, well, it's that lack of communication. It's the cool hand Luke moment. What we have here is a failure to communicate. If you can't make that understood to a third party, you compromise your ability to make a deal. So clarity, both in your own mind and in what it is that you present to the world at large, will help you get farther along, I think, with your real estate investing.
No, absolutely. I love every bit of it. Thank you so much for sharing that, Frank. And thank you for joining us here again today and for coming back. And I hope it's not 5 years before we speak again. So we'll have to probably make it a regular occurrence, maybe once a year or so, because 5 years is way too long. Too much happens in between that time span. So with that being said, I really appreciate you coming on the show. And for folks that are tuning in here, if you'd like to learn more about Frank and his company and the different financial solutions they provide, you can go visit him at realdata.com. Again, that's realdata.com. And we'll also be putting a link to that 30% page or I guess promo code in the show notes as well. And so with that, Frank, that's all we have, my friend. Really appreciate you coming back here and look forward to staying in touch with you. Okay. You take care.
Thanks so much for having me again.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.